In this video, we will take another look at the collapse of the Silicon Valley Bank. More specifically, we will explain why no regulation and no public authority was able to prevent this financial disaster. And even more interestingly, we are going to explain to you why many politicians and journalists are pointing to Donald Trump as the ultimate culprit of this latest banking crisis. Yes, you heard me right. Donald Trump is the one to blame for the collapse of Silicon Valley Bank. You don't believe me? Well, judge for yourselves.
Democrats placed blame for the collapse of Silicon Valley Bank over the former President Donald Trump.
For what reason is Donald Trump being singled out as the culprit for the recent financial storm? Is he really responsible for what has happened? What lies at the root of this entire story? Well, today on Visualeconomik, we will answer all of these questions and pay very, very close attention to this episode. One of the most important questions we are going to answer in this video, and the one that is closely related to Donald Trump, is why banking regulations failed to prevent the collapse of Silicon Valley Bank. The 2008 financial crash was an absolute disaster. The banks basically did what they wanted. They took too many risks, and their massive greed led them to cause the entire system to crash. After that, politicians realized that if they wanted to prevent a future crisis like that from happening again, they had to increase regulations and tighten control over financial institutions. And that was something they did with the Basel III Accords. Basel III
tightens capital requirements.
The Basel III Accords incorporated tougher, more numerous, and more effective control measures on the banks themselves. However, in this video, we will focus on the three most important measures of all. Three measures that were intended to solve three different problems that could potentially bankrupt banks, and therefore all of us. Do you want to know what problems we are talking about? Of course you do. So let's find out. Well, the first problem that could lead banks to bankruptcy is the lack of sufficient capital. Now, what does that actually mean? This means that if banks have little equity capital, that is, little accumulated wealth in their own accounts, then they cannot respond to possible losses in the event of a crisis. This is something that happened, for example, after the real estate boom of 2008. At that time, banks had a lot of investments in mortgages of dubious quality, to say the least. As you may already know, those mortgages defaulted and the banks lost a lot, and I am talking about a lot of money. By losing money, some banks, such as Lehman Brothers, were unable to repay their debts to their customers, and therefore, they went bankrupt. Now, what would have happened if Lehman Brothers had had a larger capital cushion? Indeed, it probably could have made up the losses with its own money and would not have had to go bankrupt. This is exactly why the first Basel III regulation consisted of requiring banks to hold larger capital buffers. This cushion is measured by what is known as the Common Equity Tier 1 ratio, or CET1 ratio for short. This indicator measures the percentage of the bank's investments that can be backed by its own capital in the event of losses. Basel III required banks to have this ratio, this capital buffer, to exceed at least 4.5%. In any case, what is certain is that a bank can fail for other reasons beyond losses. For example, when there's a run on the bank. This happens when all of a bank's customers rush to withdraw their money and the bank simply does not have enough cash to return it to everyone. The second problem that can lead a bank to fail is the lack of liquidity. That is to say, the lack of sufficient cash or the capacity to obtain their cash in time. As you can imagine, the Basel III Accords also included a new restriction to prevent bank runs from happening. This restriction is known as the Liquidity Coverage Ratio, or LCR. This new regulation established that banks have to keep their properties' money or assets easily convertible into money of sufficient value to withstand 30 days in a row with customers withdrawing money under problematic conditions. However, even if these two regulations were perfectly complied with, there would still be a third problem that could put a bank at risk: the problem of instability. Even if a bank has sufficient capital, and even if it has sufficient liquidity, it is possible that in an extreme economic scenario, such as a period of runaway inflation or a massive GDP collapse, this may not be enough. It is necessary to prove that banks can withstand even the toughest and most violent economic storms. For this reason, the last regulation imposed by Basel III was the execution of stringent stress tests on banks. Every year, the public authorities determine whether a bank could survive extreme economic conditions. Well, these are the three main Basel III regulations, or at least the three that matter the most to us in this particular story. The question is, what on earth does Donald Trump have to do with all of this? Is the former president to blame for the fact that these regulations have not worked? Well, hold on, because just like I told you, you're going to need to pay attention. Here's where it gets interesting.
Time to pay the piper, Donald.
Let's see. So far, the regulations we have explained to you are those of Basel III. However, it turns out that the US likes to go it alone. In the US, the Basel rules we have explained apply only to its largest banks and only slightly modified. Be that as it may, the point is that in smaller banks, regulations are much more lax than those laid out in Basel III. The question is, how do you define what is a small bank and what is a large bank? Well, a bank is defined according to its volume of assets, or, to simplify, by the wealth that it manages. For example, until 2018, if a bank exceeded $50 billion on average in assets, it was considered to be a large bank and therefore had to comply with the regulations we have just explained. Well, Silicon Valley Bank was included among these banks, so that it should have complied with the rules mentioned above. But there was one problem. Check this out. On the left, you are looking at the assets recorded in 2018 of JP Morgan, one of the largest banks in America, and on the right, you are looking at the assets of Silicon Valley Bank that same year. The difference was huge. JP Morgan was almost 50 times larger than Silicon Valley Bank. However, both had to comply with the regulations that we have explained to you. So, does it make sense for banks of such different sizes to be subject to the same regulation? Did much smaller banks like Silicon Valley really have to go through the same costly, time-consuming, and harsh restrictions? Well, I don't know about you, but the protagonist of this story, Donald Trump, thought, no, not at all.
One size fits all. Those rules just don't work. Medium-sized banks shouldn't be regulated the same way as the large, complex financial institutions, Trump said at the White House.
From then on, no sooner said than done, with the support of some Democratic senators and congressmen, the Republican Party, led by Donald Trump, changed the threshold that determined whether a bank was considered large. That limit was increased by a factor of 5, up to $250 billion. And therefore, Silicon Valley Bank was no longer subject to such strict regulations. For example, the LCR's liquidity control disappeared. The LCR no longer had to prove that it had sufficient liquidity. At the same time, another thing that disappeared were the stress tests. Public agencies stopped checking whether Silicon Valley Bank could withstand extreme conditions. The only requirement that was maintained was the CET1 requirement, the capital buffer in case of losses. But, as we will see in just a little moment, that also had a shortfall. Be that as it may, the point is that this relaxing of regulations has led many to accuse Donald Trump of being the one to blame for this latest banking crisis.
Let's be clear, the failure of Silicon Valley Bank is a direct result of an absurd 2018 bank deregulation bill signed by Donald Trump that I strongly opposed. Bernie Sanders.
In view of this, the question we can now ask is, could the regulations, had they been upheld, really have prevented the disaster at Silicon Valley Bank? Are politicians like Bernie Sanders right to accuse Donald Trump? Well, let's find out.
Wait, who is paying?
So let's see. Regulations were a problem in the failure of the Silicon Valley Bank, but not because they were not applied, rather because that even if they had been applied, they would have been completely useless. Why? Well, let's take it one step at a time. First, let's talk about the only rule that remained in place after the Trump era, the capital buffer rule to cover against losses, the CET1 ratio. As you can see, the bank's capital ratio was almost 3 times the Basel III regulation. And you may be wondering, but then why did Silicon Valley Bank collapse if they had all that money? Well, because it had a lot of long-term investments called HTMs, investments that included things like government bonds and mortgage bundles. The point is that these HTM investments can suffer value impairments in the market. In other words, they can suffer losses. And here's the catch. You see, since HTMs are long-term investments not intended for sale, smaller banks are not required to record their losses for accounting purposes. As a result, they are not taken into account when calculating the capital ratio. Had these hidden losses been taken into account, Silicon Valley Bank would not have passed the minimum requirement. But as we have said, even the strictest regulation did not require it to account for them. Now, what about the LCR, the liquidity ratio that forced banks to have enough cash to face problematic situations? If this regulation had been applied, would it have prevented the disaster? Well, I'm afraid the answer is no.
Silicon Valley Bank would have passed the liquidity coverage ratio requirement.
The problem with the LCR is that it is not stringent enough to calculate the wildest cases of deposit loss, and even less so in modern times. Keep in mind that when these rules were designed, many people still had to go to the bank in person to make transfers. Smartphones barely existed, and the panic of the bank runs could not spread as rapidly on social media as it does now. In fact, Basel III was drawn up in 2009, back when Instagram didn't even exist. To give you an idea, in just one day, the Silicon Valley Bank lost $40 billion in deposits. That was 25% of its total assets. The LCR could not have foreseen that, not by a long shot. In short, 2 of the 3 most significant regulations we have discussed have been, or would have been, utterly useless. But there was still one last regulation, the stress test, those rigorous examinations of banks by the authorities to demonstrate their soundness, even in the most extreme situations. Would these tests have worked if they had been applied? Well, what can I say? I think you can probably guess the answer. In case you can't, it's no, they wouldn't have worked either. And so why is that? Well, because these stress tests were designed to avoid problems in crises such as those of 2008, not in crises such as the current one. To be more specific, the Federal Reserve's stress tests assumed a potential catastrophic scenario to be one with a sharp 10.1% drop in GDP, low inflation of 2.3%, and ridiculous interest rates of 1.1%. This is a catastrophic scenario that fits very well with the 2008 context, but very poorly with the current one, where rates and inflation are skyrocketing. And this is very important because precisely what caused the Silicon Valley Bank to collapse was that interest rates were too high, much higher than that hypothetical catastrophic scenario. In other words, the bank would also have passed the stress test without any problems. So in short, none of these regulations eliminated by Trump would have prevented the collapse of Silicon Valley Bank. As a moral to the story, economists, or in this case, regulators, hope to resolve new crises with the formulas that would have worked for the previous one, but that does not always work. That's like a general trying to fight the last war. Be that as it may though, it's now over to you. What did you think of the regulations we have outlined? How do you think they should be changed or tightened up to avoid future disasters? Would you apply tougher restrictions, or do you think the problem lies in elements such as bailouts or greed? You can leave us your answers in the comments below. If you like this video, please like it, and don't forget to subscribe to our channel so you don't miss any of our upcoming videos. I hope you enjoyed it. All the best, and I'll see you next time. You took my money out of the bank, right? Silicon Valley. What?